Every time you fill up your tank, swipe your credit card at the grocery store, or wonder why your flight just got more expensive, the answer right now traces back to one narrow strip of water. 21 miles wide at its tightest point, and it's slowly strangling the global economy. Right now, oil markets are in a state the world hasn't seen in years. Brent crude, the global benchmark, has been swinging wildly between $102 and $110 a barrel, refusing to fall below triple digits. And the reason isn't just supply and demand. It's a geopolitical fuse that's been burning for 3 weeks now, and nobody knows when or if it stops. This is the story of the Strait of Hormuz, what's happening there right now and why it directly affects your money whether you own a single barrel of oil or not. The Strait of Hormuz is a choke point. That's the only word for it. Roughly 20% of the world's seaborne oil passes through this narrow passage every single day, along with a massive share of the world's liquefied natural gas. Think of it as a pipe, a very, very important pipe, and right now that pipe is nearly shut. The U.S. Israeli conflict with Iran, now entering its third week, has turned the strait into a no-go zone for commercial shipping. Iranian officials, including Parliamentary Speaker Mohammad Bakr Kalibaf, have gone on television to say plainly that the strait cannot return to previous conditions, and that security there does not exist as long as American and Israeli forces are present. Shipping firms have suspended operations entirely. Those that haven't are rerouting vessels on journeys that add weeks and enormous costs. Insurance premiums for tankers attempting transit have skyrocketed, and some U.S. allies have flat-out refused calls to join naval escorts to reopen passage. Here's where it gets really significant. At the peak of this disruption, analysts estimated that somewhere between 8 and 15 million barrels per day effectively vanished from global markets. Vanished. To put that in perspective, Saudi Arabia, the world's swing producer, pumps around 9 to 10 million barrels a day. This isn't a minor shock, this is a seismic one. And the escalations are still coming. There have been reported strikes on Iran's South Pars gas field, the world's largest natural gas field, which it shares with Qatar. There are active threats of retaliation against Gulf refineries in Saudi Arabia, the UAE, and Qatar. Every new headline sends oil prices swinging again. Goldman Sachs and other analysts estimate that markets are pricing in a geopolitical risk premium of $10 to $18 per barrel above what fundamentals would otherwise justify. That premium isn't going away, it's being baked in. The world hasn't just sat still watching this. The International Energy Agency launched its largest ever emergency reserve release, hundreds of millions of barrels coordinated withdrawals from the U.S. Strategic Petroleum Reserve. OPEC made minor output adjustments, but here's the uncomfortable truth, none of it is enough. There is no spare capacity on the planet, large enough to fully replace a sustained Hormuz shutdown. The buffers are real, but they are temporary, and the market knows it. So what does this mean mechanically? For you, for businesses, for the broader economy? Every dollar that oil stays above $100 a barrel filters through the entire economic system like dye through water. U.S. gasoline averages are already climbing toward $3.84 a gallon, the highest since 2023. Jet fuel costs spike, which means airlines raise prices or absorb losses. Petrochemicals get more expensive, which means manufacturing input costs rise, which means the things you buy cost more. Diesel prices climb, which means trucking gets more expensive, which means almost everything delivered to a shelf or a doorstep costs more to move. This is how an energy shock becomes an inflation shock, becomes a consumer pain story. And the second-order effects are just as significant. Money is rotating fast. Investors are pouring capital into energy stocks, commodity funds, and inflation hedges like gold. Rate-sensitive growth stocks are under pressure because higher oil means higher inflation expectations, and higher inflation expectations mean the Federal Reserve's hands are tied. For emerging market economies that are heavy oil importers, countries in Asia, parts of Europe, Latin America, the currency and debt stress from a sustained $100 oil environment is severe and growing. The people who benefit right now are specific: oil producers, refiners, commodity traders positioned long on crude. The people who pay the price are nearly everyone else: consumers, airlines, trucking companies, retailers, first-time homebuyers, borrowers. And unless there is a genuine de-escalation signal out of the Strait of Hormuz, some analysts are warning that Brent crude at 120 to 150 a barrel isn't a fringe scenario. It's a tail risk that's getting fatter by the day. This is still unfolding. No resolution is in sight, and the market is treating this not as a short-term crisis, but as a new normal, a higher-for-longer energy regime that rewrites the economic math for 2026. And this isn't the only signal the financial world is sending right now. On March 18th, the Federal Reserve wrapped up its March meeting, and the message from Chair Powell was clear, even if he chose his words carefully. The Fed held rates steady at 3.50 to 3.75%. That was expected. What wasn't fully priced in was just how hawkish the tone became. The updated dot plot, the Fed's own projection for future rates, now shows a median of just one rate cut in all of 2026. Before this oil shock, markets were hoping for 3. Powell revised the Fed's inflation forecast higher, with core PCE now projected near 2.7%, as energy costs filter through the entire price level. The message was unmistakable. Relief isn't coming soon. The war changed the math. At the same time, another alarm is getting louder. Stagflation, the word economists hate using because it describes one of the hardest situations to fix, is now flashing genuine warning signs. February's jobs report showed a loss of 92,000 positions. That's a soft labor market. But inflation is running hot, driven by $100 oil and a surprise PPI reading of 3.4% year-over-year. Slow growth and rising prices at the same time. The Fed can't lower rates to stimulate the economy without feeding inflation further. It's a trap, and the 1970s comparisons are spreading fast across financial media. Meanwhile, another shift is happening closer to home for millions of people. Mortgage rates, which had started to ease earlier this year, are climbing again. The 30-year fixed rate is now sitting in the 6.07 to 6.5% range, as bond markets price in delayed rate cuts and persistent inflation. For anyone waiting to buy a home or refinance or make a major financial move, that window is closing again, and it's closing because of a straight 7,000 miles away. Step back and look at all of this together, and a single clear theme emerges. We are watching a world where one geopolitical shock, one blocked choke point, is radiating outward through every layer of the financial system. Higher oil, higher inflation, a Fed that can't cut, a housing market that can't breathe, emerging economies under strain, growth assets repriced, and stagflation in the background like a ghost from 50 years ago. The Strait of Hormuz isn't just a shipping lane. Right now it is the most consequential piece of geography on Earth for your wallet, and until there is a real, credible move toward de-escalation, the financial pressure won't release. Watch what happens next at the Strait, because everything else, rates, prices, markets, your costs, will follow that signal. If you want to stay ahead of what's moving markets before it hits the headlines, make sure you're following Finance Intel Hub. This is exactly what we do here every week.